Welcome to This Week This Morning, the weekly video that gets you up to speed on the week's most important developments for your business and your taxes. Happy Turkey Day, everyone. Some of us may have to dig a bit deeper than others to find what we're thankful for this year, but at Dark Horse, we are incredibly thankful for you trusting us with your business and your taxes. This week, I want to talk to you about two areas where the IRS has limited deductions and how current and future legislation might be creating workarounds. One of these areas is the state and local tax deduction, also known as the 10K SALT deduction cap. The other is the deductibility of expenses paid for by PPP loan dollars that are eventually forgiven. Let's start with the SALT cap. So, a thorn in the side of high income earners in high tax states has been the fact that the current tax code limits the deduction of SALT taxes to $10,000. This has lowered itemized deductions for many taxpayers by tens, if not hundreds of thousands of dollars. If you're on the wrong side of this law, it's painful. Recently, however, the IRS issued a notice stating that pass-through entities can deduct greater than $10,000 of SALT taxes at the business level if their state imposes an entity-level state income tax. The kicker here is that certain states have levied an entity-level tax that provides a dollar-for-dollar tax credit to the shareholders of the entities. In all but one of these states, the tax is elective. So if you live in one of these states, which I've listed below, the IRS has essentially given their blessing on a workaround for business owners to not be capped at $10,000 in their SALT tax deduction. It's our belief that other states are going to impose these same entity level taxes in their states as they are a political win for their residents that doesn't lower their tax revenues for the state. Just be aware that you're not going to be able to get away with creating a shell entity just to try to funnel state income taxes to get around the cap. The taxes would have to be a result of the income from the entity for this to work out for you. Moving along, let's talk about the IRS's current position on deducting expenses paid for by PPP dollars. They released a revenue ruling recently that reinforced their position that the expenses are not deductible and stated that you cannot wait until 2021 to apply for loan forgiveness to try to push the tax impact to 2021. They are stating that if you have a reasonable expectation of forgiveness by the end of the year, which the majority of entities do, then the tax impacts get captured in 2020. In other words, the loan forgiveness income will be excluded from taxable income in the same year that the expenses won't be deductible. Where has the IRS gone wrong here? Well, the CARES Act was written in a way that was supposed to ensure that the loan forgiveness was not taxable. However, if it was taxable, then the expenses would be deductible. So that scenario and the current position by the IRS both get you to net taxable income of zero. So by disallowing the deduction of PPP related expenses, they have essentially made the loan forgiveness taxable. If your head is spinning right now, just remember that the intent of the lawmakers was for the loan forgiveness to not be taxable and for the expenses paid for with the funds to be deductible. The AICPA, the Senate Finance Committee, and others are fighting the IRS on this position. If they are unsuccessful, expect for this to be included in future legislation, possibly by year end, or in the next stimulus package in Q1 2021. While you can't take anything to the bank that hasn't made its way into law just yet, it is our belief that the IRS's hand will be forced to allow the deduction of these expenses. We'll be keeping a close eye on this and we'll update you when we know more. That's all for now. See you next week.